How you doing, ladies and gentlemen? Welcome to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. And uh, I got it for you. I did what I said I was going to do. I pulled it out of the woodwork. That's why I'm starting later than I even start later of later, because I had to make sure that I had everything all the way down to the tax dollars that could impact or negatively impact this particular method. So I told you guys yesterday and the day before that I was going to be walking you through the dividend rotation strategy that we're using and give you the lineup that we're going to be having for the month of July as we start going into August as well. And since our first trade is tomorrow, and you should get into it before the end of business day tomorrow, recognizing that the end of business day is 4 p.m. Eastern Standard Time, which in California would be 1 p.m. So you got to get them trades in before lunch. But if you do your sells or do your buys before noon, regardless of whether you're on the East Coast or the West Coast, you'll be locked in for the most recent trade that we got coming up. I want you guys to like and subscribe as you come in. Hit that follow button. If you're watching us from Twitch or Twitter, you can hit the like button there and follow the channel from there. On YouTube is primarily where all the information is located at. So if you want to replay the show in real time, the comment section is played in real time. I've tested it and confirmed it. The stocks that I'm going to be giving you today, I'm also going to put it in the comment section. So you will be able to replay the video archived on a YouTube platform and get those stocks down. So if you didn't bring a pen and paper to the show today, no worries. You can always come back and get the information at a later date and time. But if you have the opportunity to picture in picture and do some trades while we're talking, we can go ahead and make that happen. We're live 7 nights a week. We don't let the sun rise without going live. And we have a different topic every day, but Monday, Tuesday, and Wednesday, we talk about ways for you to improve your money and what will negatively impact your ability to improve your money. And then Thursday, Friday, and Saturday, we talk about how you can improve yourself so that the decisions that you make doesn't negatively impact the money you just made. Sunday is our members only shows where we have questions and comments from the fans, everything under the sun, including politics, religion, and STEM topics. So it doesn't matter what it is. We go over it all on this show, because on This and That, we talk about this, that, and everything in between. Since I'm more than a half hour later than what I anticipated, we're going to go ahead and dive right in. And I want to get something straight real quick. What is the stories that you have been told about growing your money? The one that says that you have to buy and hold for 40 years, that strategy, the rule of 72. It isn't the only story that is out there, guys. You guys have to think about it. You're told just to put your money in an index fund and forget it. You know what I'm saying? You're told that trying to time the market is a fool's game, and you're told to celebrate an 8% return in a good year. And for many people, that's genuinely sound advice. Long-term diversified investing is a proven path for building wealth, and it's the right choice for the vast majority of investors. But what if you're not like the vast majority? What if you're someone who wants to take more active roles in your platform? What if you believe there has to be a way to generate cash flow from the market on your own terms without waiting decades to see the results? There is another way. It's a strategy that I personally am using every month since I introduced it to you guys about 8 weeks ago. And it is used to generate approximately 168% return on my capital. And we have been talking about it throughout the week on some of the upcoming terms, because I had gave some trades, because we had one that was we had to buy it in yesterday so that we would have the ex-dividend date for tomorrow, so that because it was Jinko that needed to be invested in. It's a little late now because the market has closed, but had you been following us over the weekend, when I gave you the heads up that Jinko had to be bought before 4 p.m. today so that you would be on the books for the ex-dividend date for tomorrow, and that one is giving $1.74 a share or something like that. for the annual return, but it's a one-time payment on the stock, and you're going to buy it a day or two before the stock, be on the books the day of the ex-dividend date, sell it after that, and your dollar and some cents change. Special shout out to Steven from Twitter. That dollar and some cents change per share, you pick up a few hundred shares, you would have been and picked up a few $100s off of that. If you did like Steven did and you picked up that trade this week, you'd be sitting in it right now. And all over the course of 4 days, you would have been able to put up what we discussed, like $4,000 you could have put down on that stock and got back $300 in 4 days of just putting your money somewhere. Took all of 20 seconds to make it happen, both days out of the week, and then you'd be sitting there looking at Jesus Christ of all the money. Now, he said, my bad, didn't see the live. I was using my Quest. Hey, no worries. This is why I tell you guys to, if you like the channel on YouTube and have the push notifications active, when the podcast goes live, it sends you a text message and say, hey, you went live. Then if you want to watch me from Twitter, you can just log into Twitter and pay attention. So you could be watching YouTube, Netflix, you could be playing video games on your cell phone, and then all of a sudden you get a text message, the podcast went live. You didn't miss anything. We've only been here for about 10 minutes because I started massively late to make sure that I got all the numbers together, including the taxation. Oh man, that Two Rivers coffee is hitting the spot. This one with the peppermint tea flavored coffee is very good. And no, we're not doing this over decades. This is in a matter of months. We have been talking about over the past few weeks how we have bought and sold stocks. Like, for example, AG Mortgage just sold with a $250 increase plus the dividend distribution on just that one stock. And then he said, you saw that big bill pass, bro? It's over. We're cooked. I did not see the big bill pass. Are you talking about the big, beautiful bill? Because Donald Trump was trying to push that bill and that pissed off Elon Musk, and it was supposed to be negatively impacting electric vehicles. You're talking about the big, beautiful bill. Oh, ladies and gentlemen, this is a highly interactive podcast. So if you're watching from Twitch, Twitter, or YouTube, and you appropriately put your comments in the comment section, I will respond to them if I see them. If they're inappropriate, mildly, then I won't acknowledge them. And if they're grossly inappropriate, then like yesterday, I will definitely have to ban you. I'm not against trolls. I'm just against negative behavior. So if you want to troll in a positive fashion, you're good. But if you troll in a negative fashion, you're gone. Oh, it passed. He says, so the big, beautiful bill is passed. He's going to sign it later. It's over, bro. Time to move. Some people can't afford to move. Is it what happened yesterday? What happened yesterday with what? He says gonna you talk about the guy yesterday. Oh, remember yesterday we had the troll that was on the show and he was doing what he was doing, and then all of a sudden I was like, well, blocked you. And then he came back 4 more times and I blocked like 3 of his accounts. Yeah, I had to chuck somebody out of the comment section yesterday. Doesn't happen very often, but when it does, it's like really inappropriate comments. Yeah, people have. I don't mind not having a life, but being so depressed and bored and self whatever deprecating, and then you have to find validation in yourself by demoralizing somebody else, that I have a problem with. You can be boring. I'm boring. I'm a couch potato. I can be adventurous if you get me to take 2 steps out of the house, but if I can find a way not to go outside of the house, I won't. And the fact of the matter is that I'm not going to take anything that I got going on out on anybody else. But other people who have no life, who are bored out of their mind, and they have nothing else to do, nowhere to go. They have so much energy that they can't sleep, and they're trolling a podcast. They're trolling the entire platform, and it just fell into this podcast. And because I respond to people, then they want to start interacting. I'm like, hey, I'm okay with that, but I'm just not okay with the negative ones. We the same then. Yeah, exactly. So it's like if I end up taking 2 steps out of my house, I find myself gone for like 5-7 hours because, Like I deliberately, and this is one of the things that I tell you guys to do when it comes down to other things. So we're going to get back to this dividend rotation. I want you guys to know I'm going to be giving you stock information today. So don't go nowhere, because throughout the show, I'm going to be putting it into the comment section, the stocks we're going to be trading on this month. But real quick, I deliberately put important things that I have to deal with on the other side of town. So it forces me when I got to go get the mail. I don't collect mail at my house. I got to go to a post office box. When I got to do business, I got to go downtown. I don't live downtown. I've got if I want to go to the office is on the other side of town. So anytime I have to do something, I have to go cross town, literally, not figuratively. And that means that it's 30, 45 minutes, an hour, 2 hours in one direction, do everything I got to do, and then drive back. I'm not in a rush because I work for myself. But the fact is that, as much as I loathe getting out of the house, once I turn the car on, I'm like, fuck it, I'm outside now. We're going everywhere. I be mapping a route like I'm gonna go here, go here, go here. Okay, so you're asking me what we're learning about today. Remember, I told you over the week that I was going to give you the dividend rotation for the month of July. So I was going to give you guys a tip off of the stocks that we're buying into and selling, and which days of the week that we're going to be buying and selling them. And I'm going to be reminding you throughout the month to do it, but I'm going to be giving you all the ones that we're using so that you can do it with us. I'm giving it to you in advance because I want you to have the ability to do your own research and plan to do it. Put your money away in case you're going to do it. If you're not going to do it, I don't care. I'm doing it. Fuck that. I'm making a shit ton of money. But if you're going to do it, I want you to be able to make an informed decision. I noticed that they got gifts on the virtual feed right now. So if you guys benefit from the information that I'm giving y'all and y'all want to throw something to the channel, because I have to pay Twitter to podcast on Twitter, you could always support the cause and throw something at the channel some kind of way. And Twitter is not monetized, so you'd have to throw something at the YouTube channel in order to get me what I need done to cover the cost of streaming on Twitter. But it is what it is, because what I make off of the stock option goes into the podcast, and that's a tax write-off because the podcast is part of the business. Steven said, yes, sir, we need to make that money. So let's dive right into this. And I'm giving you guys the heads up because this isn't a gamble on some new crypto coin. It's a method that hides in plain sight using the market's own mechanics. And I told you guys before, this is called the dividend capture strategy. And today I'm pulling back the curtain to give you the complete blueprint, the good, the bad, and the brutal honesty about the truth that is related to how it works, why it works, and the hidden traps that cause most people who try it to fail. Because I've noticed that in a declining market, the dividend capture strategy is not going to be effective, because if you buy the stock, it's going to drop after you buy it, and then you'll sell it, and then you'll buy another stock, and then it's going to drop, and then you'll sell it. In a declining market, which we've already hit rock bottom. But so if you would have been trying this in January, you would have been failing. But because it has already hit rock bottom and everything is starting to stabilize, in a declining market, it went out of work, but because it is stabilized now, it is going to work now. And as the market starts to recover in what is called a bullish market, every time you sell, it is higher than what you bought in, because the rich people are putting their money back into the stock slowly but surely. Now, this means that whatever you do, you always have to make sure that you have extra money lying around in your trades, because if you buy a stock and it dips, you can't sell it until it goes back up, so that you're not taking a financial loss, which means whatever capital is tied into that particular trade is stuck in that trade until the value goes back up. But as the market is increasing, you might have to wait an extra few days. You might miss a specific trade, but you will be able to continue utilizing that money to trade throughout the year, which is one of the reasons why you're not supposed to put all of your money on any one trade, because if it goes into that stock and then it doesn't come back out, it's kind of stuck, or you're taking a loss in order to keep the rotation going. And that's what some people have disliked about the dividend rotation strategy, is that if they have to forcibly sell the stock in order to keep trading, they will take the loss regardless of how large the loss is. And when that happens, they're not satisfied with the difference between what they made versus what they lost. So they'll do something like buy and hold. Stick with me, because this is the kind of information they charge thousands for, and you're about to get it all for free. Which is why I encourage you guys to join a membership on the YouTube channel, because now that I think about it, I should put this information into the archive on the membership so that you'll always have access to it as we go through it. He said they can buy and hold. Yeah, so that is how the dividend rotation strategy is the most effective, because if you only buy and sell regardless of the outcome of the stock, you're going to take a loss. But if you switch from buy and sell to buy and hold because the stock is going down, and keep adding money to your portfolio, when you can sell, you will sell on a gain. And when you can't sell, you hold the stock and you don't take a loss and collect the dividends and then just sell the next time it's up. As long as the next time it's up is not right before the ex-dividend date, if you were going to invest in that stock anyway. Now, if you had to hold for the month and it's about to roll back over for the ex-dividend stock a second time, then you leave the money in there and you take the rest of the capital that you have and trade through the quarterlies. So you can buy into a monthly stock, do a buy and hold, leave that money there, take the rest of your money and switch through the quarterly stocks, because the quarterly stocks pay once every 3 months. And since it pays once every 3 months, it might pay January and then it pay again in April. So you're going to have like 2 months of downtime. And then, you know what I'm saying? Because once every 3 months, it'll pay. And that's what you want to catch. You want to catch those quarterly stocks, because a quarterly stock will give you one payment that is as large as 3 smaller payments. But if you're doing a dividend rotation strategy, every month you're getting a 3-month payout in 1 month for each stock that you hit. And you're grabbing a different stock every month, which is going to be 3 times larger than the monthly stocks that pay out whatever they pay out every month. And that is going to be why the dividend rotation strategy is so effective the way I'm doing it. So I'm going to be honest. How many of you have felt that sinking feeling when you look at your investment account? You do everything you're supposed to do, right? You contribute from every paycheck. You diversified your portfolio. You rebalanced everything. You listen to the experts on TV who tell you, stay the course. And what happens? Your account inches up only to get knocked back down by the next market correction. You're playing a game where financial freedom feels like a finish line that always moves further and further away. You're told that a patient buy and hold approach is the only sensible path. Well, if you got too much shit to do to make that trade, then that might be the case. Matter of fact, a lot of the wealthiest individuals do not socialize with people during their scheduled trading time so that they can make sure that they buy and sell when buying and selling needs to occur. Then the rest of their day, because you don't have to spend all day doing the trade. I got to the show like 30 minutes later than what I wanted to get to the show, because I had to organize a script after I pieced together all of the data for the channel. But it literally took me 15 minutes to put all of this information onto a document and have the schedule set up for the next month. So if that is all I have to do for the next 30 days, and then take the time once a week or twice a week to buy and sell a stock where it is only going to take me 30 seconds to look at my calendar, go to the stock, buy it if it's supposed to be bought, sell it if it's supposed to be sold, and then wait for the money to settle into the account before I buy something else. The only other thing I might spend an extra 30 seconds deliberating on is exactly how much of the available capital that I have am I going to invest if I have more than one stock back to back that needs to be bought. And I can't put all my money into one stock and then move it to the other stock because they're too close together. So I would have to split my money and buy into one stock and then buy into the other stock and then sell the first stock first and sell the second stock second and then move the money into the other stock. But if I decide that I want to put all my money into the higher paying stock, risking a loss if the stock were to decline, if the stock is still in a bullish position where I'm going to receive a gain, then I'll buy into that stock, receive way more than what I would have if I split the money. Yeah, I didn't buy into the other one, but who cares? Because if the one I bought into is paying out more than the one that I didn't buy into, then I just made the most money I could have made with the quantity of money that I had. And while individuals are being told to buy and hold, and that is a safe and effective strategy for long-term goals, it's also incredibly passive. That passivity is the real issue. It's agonizingly slow and you have almost no control. You're just a passenger on a roller coaster driven by global events and institutional traders, which is the reason why I tell you guys about all the stuff that happens in our society that negatively impacts the money. And so much shit has happened this year that the market has been the most volatile it has been in a very long time. He said, how did you get so much experience from stocks? Well, I started researching the stocks for the podcast, and I continue to research the stocks for topics related to stocks on the podcast. Then I started putting common sense together, and then I started saying, well, you know what? I need to put this into action because I'm talking about it. Then I started putting it into action. And while I'm putting it into action, I'm not failing. And while I'm not failing, I'm telling you guys to put it into action too. And because it is a well-known strategy that wealthy individuals have utilized, it is when they utilize it that is the benefit, not if they utilize it. Because if you utilize it all year in a stable market, when the market starts to crash and you're still buying and selling, when you buy, it's high, and when you sell, it's low. And every time you do that, you're taking a loss. But when you buy, it's low, and when you sell, it's high. Every time you do that, you're making a gain. And when I recognize that we're in a barren market where everything was declining because of the tariffs that was about to hit, I said, look, now is the time to dive in. If your ass was broke last year and you didn't buy into the Bitcoin before it doubled its revenue and went from 50,000 to 150,000, you now it's time to get into these damn stocks. So that's when I started saying, all right, let's literally look at how we can invest in this and start putting our money into some stuff. And I started in February and March. And I was telling you guys about how just do a buy and hold, rookie move, buy and hold a cash stock. It'll pay you every month. If you buy a growth stock, the value of the stock is the money that you can borrow against if you're trying to borrow for a cash stock, or borrow for a cash loan. But if you buy a cash stock gives you a percentage of the money back every month. So even if you need money for something, you're not pulling the money out of the cash stock because the cash stock is giving you money for holding your money. A growth stock, you have to sell in order to take care of a financial problem. So I said, let's start doing that. So I started looking into all of the cash stocks that existed. I'm not going to waste your time with bullshit. And I went straight for the highest paying cash stocks with the lowest cash buy-in. That way you get the most for your money. Then I started putting it together like, holy shit, there's a lot of them here that if we put this together, we can make a decent quantity of money every month. Then I started looking at strategies on how to trade. So went from a rookie move of just buying and holding and started doing an intermediate move of trades. Then I went from that to different trading strategies like the dividend rotation strategy, which offers 168% annual return, which is more than double what you put in. So if you put up $1,000 and you hit every stock along the way, you're likely to see $1,600 of profit plus your principal, which is $2,600. So if you started with 1,000, you end up with 2,600 at the end of the year. That's a good return. So I said, let's put this into action and see how well we do. And as I started buying and selling, I started selling more of the ones that I was holding and started using that larger quantity of capital to buy into more of the stocks that needed to be bought into. And then I started seeing larger returns. And now I'm triggering certain stocks that are starting to go on the incline. And I'm looking at $75 payouts for the dividends, $100 payout for the dividends, then $300 for selling the stock. So now I'm looking at like $400 or $500 for each time I sold something. Like, oh damn, I'm starting to make more money off of selling 3 stocks than some people make all month working 80 hours a paycheck or 75 hours a week. And it's like, oh snap. So I'm telling y'all, hey, it's paying out a lot. It's paying out a lot. I made 3 times more this past month than what I made the month before because I just started doing a dividend rotation strategy. At the beginning of June, I said, hey, let me look and see if we can add more stocks to the fold, because I had a few quarterlies and a few monthlies. And the quarterlies are what you're rotating out of more than the monthlies, because the monthly is going to pay out every month. And the monthlies are the lowest costing stocks with the highest payout percentage. The quarterlies are just 3 payments into 1 payout. So I said, let me find more quarterlies. That way we have more to rotate through. I'm only getting the ones that are worth your time. It's worth my time. By doing so, you'll be able to see, oh, well, if we invest in these, then, we'll be able to we'll get a cash return, and we'll get the difference on the increase of the stock. And each one of the stocks that I have is up. And like I told you guys, I started with $1,000 and now we're at $5,000. And I'm like, all right, it's not that hard to do. Rookie move. Anybody with an idea can make this happen. He said, yep, I always do that. Buy low, hold, and sell high when I know it's going to crash. I don't give a fuck if it crashes. I'm going to sell before it crashes. But if it decides to crash before I sell it, I hold it until it goes back up, because what goes down must go up in the stock market, unless it's a company that's going out of business. If it's a blue chip company that's been around for 10 or 20 years, it's going to go back up eventually. So what I did was I grabbed the ones that were not going anywhere. A lot of them were real estate investment trusts. All of those stocks that I grabbed are negatively impacted by the tariffs. That's why they took the big dive, which means that they are at about 35 to 40% of what their actual value would be if the tariffs wasn't kicking them in the ass. So when they did the lift on the tariffs, guess which ones are starting to rise right now? The real estate investment trusts, the ones that I gave you all the information on: January, February, March, April, and May. So that means that while we're buying and holding right now, up until like August 15th, it's on the rise. And as long as it does not go back up to 145%, we're going to start seeing more improvement in real estate, which means all of our real estate investment trusts are going to start seeing more improvement, which means that all of our trades are going to get cash off of the sale and dividends off of the hold. So I'm like, all right, let's really make this shit work, because this is the type of market that you want to do something like this in. When the market tanks, you just have to sit there and take the hit if you're not going to follow my lead and do something different. So this feeling of powerlessness is what keeps people anxious about their financial future, and the belief that you can't be in the driver's seat is the biggest hurdle over the difference between buying and holding and trading yourself with all of the fintech out there. Special shout out to Fintech 101, where you can do this on your own, and you don't have to be a mastermind to do this. You don't have to be a PhD in accounting to do this. You just have to do your research and come to the show every day, and let's talk about it. And you'll come to find out that there's a lot of money in play that you could be putting into your pocket. So I was there once before, and I felt the same frustration. I read the same generic advice, and I finally decided there has to be another way. So I started digging into this market mechanics about 6 or 7 months ago, and not the theories, but the actual plumbing of it. How does it really work? Where are the little inefficiencies? And an individual can actually use this, is what I wanted to find out. And that's what led me to how the dividend capture rotation really works. And it's not a secret, but it's often dismissed because the details of how to do it right are conveniently left out by a lot of traders. You know those guys that tell you, oh, well, if you buy my stock, blah, 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 and then, or buy my membership, and then I'll tell you what to buy. They'll make the trade, then you make the trade, then they make a trade before you make the trade. So all the people that's following them bought in after you bought it, or after the seminar bought in, and then the seminar sells before everybody else sells. So that person controls the market, right? And it's crazy. Now, everybody still makes money. They're not being cheated out of the deal, but they're renting the information from the person who's controlling the market. Because if somebody says buy into the stock, they buy into it first. Everybody else who buys in after that, the stock goes up. And if you sell before everybody else sells, you got the largest return off of that stock. So win-win for everybody. But with the seminar individuals, you paid him for him to tell you what to do, and then you paid him by following his instructions. And that's one of the reasons why I say on a regular basis that it makes absolutely no sense. Why are you paying him to get the information? You should be donating money to him because you appreciate the fact that he made you so much money. It's like giving to the church. Why am I required to give you money in the collection plate so I can walk out, Reverend Sapp? Why shouldn't I just give you some money because I feel blessed at the fact that I was receiving my harvest this season? That's what I'd be trying to tell them. Now, the reason why they don't tell everybody is because when you do it right, it flips the script. It turns you from a passive passenger into an active driver. And it's a strategy for targeting predictable events to generate cash flow, such as when I told you guys that I noticed that Orchid Island dips on the 23rd. So if you buy it on the 23rd and hold it to the end of the month and sell it on the 1st, you get the most out of that stock regardless of what happens. People don't know about stuff like that. But I watched it, I followed it, and then I was like, oh, dip, I'm gonna do this. And then I did it, and then I was like, oh, dip, I'm gonna keep doing it. And then I tell everybody else. And that's a concept that challenges the traditional model of just handling your money or handing your money over for someone else to manage it for premium, because they will charge you a percentage. So while, yeah, they'll move money around using the same tips and tricks that I'm using, make you a bunch of money, and they're going to take a bunch of money out of your pocket because that's what they're doing for a living. So you have accountants that's making 100, 200, 300,000 a year because they're taking a percentage, 1% or 2% or something like that from each one of their clients when they're making this trade for the number of clients that they have under their portfolio. So as long as their clients are making money, they're making money off of trading for their client. I'm okay with that. But if I am not a millionaire, I don't have the money to pay somebody else to make trades for me. So I got to make trades for myself. And if you have the capabilities of making trades for yourself, you have the capabilities of making yourself a millionaire. Steven said, I'm required to give you a follow for free money. You give me a follow on the podcast, a free follow, so that I could give you free information about putting a bunch of money in your pocket that you didn't have to go to work for. So how do we do this so-called secret that nobody wants everybody to know, the dividend capture strategy? The concept is incredibly simple. You already know what dividends are. A company makes a profit and shares a piece of it with its shareholders as a cash payment. The dividend capture strategy is all about holding a stock for the absolute shortest time needed to capture that dividend payout. You're not marrying the stock. You're not even dating it. You're showing up just in time to collect dividends, and then you're gone. Just like how most women treat men these days. They show up just in time to get your paycheck, and then they're gone. And they claim to be your girlfriend the entire time that they're gone. To do this, you only need to know about one critical date, the ex-dividend date. This is the cutoff. Anyone who already owns the stock before the ex-dividend date gets the dividend. Anyone who buys on or after that date does not. So the basic strategy looks like this: find a stock, which I've done, and that stock is about to pay a dividend. Buy it the day before the ex-dividend date, which I tell you which dates those are. Hold it overnight. Sell the stock at the end of business day on the ex-dividend date or the day after the ex-dividend date. You want to sell it reasonably close to when the ex-dividend date has resolved itself, because a lot of people are going to start selling within that week based on their availability. And the more people that sells, the quicker the stock starts to decline after the ex-dividend date. So if you're in it a certain day before it goes up to its peak point, it's going to have a decline of the value of the share. So let's say that you're buying a stock that's like $10 a share, and the stock has like a 15-cent payout per share. The $10 stock would drop 15 cents, and then it'll be at like 9 and some change, and then it'll give you your dividend per share. And if enough people bought into the stock, where if you bought into the stock at say 970, 971, and they bought into the stock and now the stock is at like 1015 or 1005, it takes the 15 cents off per share, but it's still now recorded at like 7 to 10 cents more than what you bought in. You're going to make 10 cents per share profit off of the sale, and you're going to get the ex dividend. That's what we're experiencing right now in the market. Steven said, yep, this morning I made 2K from different stocks that I bought a lot of shares. And that's what you do. The more shares that you have, the more dividends you get paid. And then when you make the sale, the more that you sell, the more money that you get paid. So you get paid twice off of the same transaction, because you own the stock before the cutoff. The company sends the cash dividends straight to your brokerage account on the payment date. Now, you should be thinking, if it's that easy, why isn't everyone doing it? And what's the catch? That's the right question. The catch is what happens to the stock's price. In theory, a stock's price should drop by the exact amount of the dividend on the ex-dividend date, but that's not always the case. It makes sense because, as I just explained, if the company pays out $1, the share is now worth $1 less per share. So a $50 stock, they pay out $1, theoretically now going to be $49 at the opening of the day. But if this happened perfectly every time, the strategy would be useless. So you'd make $1 on the dividends and a loss on the stock price, right? But here's the inefficiency that we can exploit. The market isn't perfectly efficient. It's driven by humans, emotions, and a million other factors. So while the stock price does tend to drop, it often doesn't drop by a full dividend amount, or it recovers very quickly. The daily nose of the market, when they stick in their nose in other people's business, can often overwhelm a small, predictable dividend drop. For example, a $50 stock might pay 50 cents of dividends, and it should be open at $49.50. But if the overall market is strong, and it might only dip to $49.75 or open flat, if you sell at $49.75, you've captured 50 cents of dividends while only losing 25 cents on the share price. I tell you guys about how recognizing that it was supposed to be at 50 and you bought it at 48, and then it went from 50 to 49, and you're walking out with $2.75. So instead of your net profit being 25 cents a share, it's like $200 plus the $50, and you're like, oh snap, right? But if you were doing this with 1,000 shares at 25 cents per share gain, you still would be pulling away $250, and you just made that in 24 hours, and it only took you like 30 seconds to make it. So now imagine doing that repeatedly throughout the month. You would start making more money off of the dividend capture strategy than what most people make off of 2 full-time jobs that they would have to work all month long. The goal isn't to hit home runs every time. It's about hitting singles over and over and over again, letting those small, consistent gains compound. You're not waiting for returns. You're actively going out and generating them. So if the strategy is this straightforward, why isn't it all over financial news sites? The real reason isn't some grand conspiracy. It's actually more cynical. The big firms don't promote it to you because they know that for the average undisciplined person, it's a perfect way to lose money. And that just creates problems for them. Let me explain. The big institutions absolutely engage in forms of dividend arbitrage, arbitrage, but they do it with some supercomputers. Microscopic transactions cost a massive scale. They can profit from a one set discrepancy multiplied by millions of shares. They know that when a retail investor tries this without a deep understanding of the pitfalls, it's dangerous. And I want to talk about those pitfalls right now, because knowing them is the only way to have a chance at succeeding. Now, the biggest trap is underestimating the price drop. So I said it doesn't always drop by a full amount, but sometimes it drops by more. If a stock pays 50 cents in the dividend, but the company also gets some bad news, it could easily fall by $1, and now you've lost a collected $1.50 in the stock, and you're in the red. So the novice trader panics, sells at the loss, and says the strategy is broken. In reality, they just failed to manage their risk. So this is what destroys most small accounts. Every trade has costs, even with commission-free the trading. There is a bid ask spread and a hidden cost on every single trade. When you trade frequently, these tiny costs add up and eat away at your profits. Then comes the big ones, taxes. The dividends you receive from the strategy are almost always non-qualified or ordinary dividends because you hold the stock for such a short time. In order for them to be qualified tax exempt or tax reduced dividends, it has to be held for 120 days, where it's 60 to 61 days before the ex dividend date and another 60 to 61 days after the ex dividend date, which is a buy and hold, which is what you want to do with your monthly stocks. Your quarterly stocks, you want to rotate out, which means that you would have the type of cash stock portfolio where more than half of your stock is held in quarterlies and the remaining money is being let me rephrase that. More than half of your stock is held in monthly stocks, and then the remainder of your cash is being rotated out in quarterly stocks, so that you're doubling your quarterly stocks, which is giving you 3 times more money once per month for every stock that you hit in comparison to the quantity of money you're going to get from your monthly stocks. So you got 2 stacks of cash. If you had 10 grand or 15 grand, you would have 10 grand in a buy and hold for monthlies and 5 grand being turned into 1,500 or 15,000, which means that your 10 grand will give you a guaranteed 20% if you're grabbing the stocks that I'm telling you about today. And then your dividend rotation is going to double the 5 grand that you're rotating out. So it's going to go from 5 grand to like 10 grand or $12,500, something like that, because you're going to get more than 150% of return plus the principal, which means that your overall 15 grand could ultimately end up being like 20 to 25 grand by the time you're done in a single calendar year. So unlike qualified dividends from long-term investments, which gets favorable tax returns, non-qualified dividends are taxed as ordinary income, and that means that they're taxed at your marginal tax bracket, which could be either 22 or 24%, or even as high as 37%, because it is the total taxable income for the household, the money you make on your W-2 or 1099 job, and the money that you made off of the stock option. That's what people don't pay attention to. So if you include taxation on it without the tax breaks, you're looking at a very shitty scenario that almost makes the trading not worth it for some people. But I've already told you guys in plenty of other episodes on how your LLC and certain purchases that you make through your LLC are tax exempt, or not tax exempt, but they're tax deductible, which comes off of the taxation from the stocks that you're making profits off of. So you end up in a position where you're spending more money on tax deduction items under the business to not pay taxes off of the money that you're making, and whatever you're getting for the business, you personally benefit from as an individual, which means you're ultimately getting free stuff instead of sending a bunch of money to Donald Trump for him to add to the $600 billion defense plan. Think about that. If you make a 2% profit, but have to give 24% of it to the government, your real gain is significantly smaller. Without careful planning, like using a tax shelter account like a Roth IRA, the tax drag can turn a profitable looking strategy into a losing one. One more thing I told you guys about is if you establish yourself a trust, any money that you donate to the trust is a donation, and that is a tax deduction. And the trust, if the trust takes it in as a principal, can pay the beneficiary of the trust. And since the trust did not turn a profit, the beneficiary is receiving non-taxable income, which is a strategy that could also bypass taxation because you gave away the money and then somebody gave you the same amount of money. This is not laundering. This is legal transactions. If you get a offshore trust account, like I gave you guys information about those offshore trust accounts in certain countries that are non-taxable countries, even if it was taxable income, it goes into a country that doesn't tax its citizens and it's a non-residential trust. That trust is still going to give you non-taxable income because the trust is not being taxed. So you're not being taxed. So you just received money that's free money. And anything that is non-taxable is not required to be reported on your taxes. I give you all of this information, and we had Joe Mastrani on the show for quite a bit, and we were talking about all of these tax tips, and I learned stuff along the way, and then I just share it with you guys, and I remind y'all when it becomes relevant again. So the next thing we have is the third trap, the myth of easy money. It is, in fact, easy money per se, but you got to be smart about it. This strategy isn't pushed on the masses because it requires work and discipline. So while it is technically easy money because you're not doing backbreaking labor to get the money, you're not up for days on end, 18 hours a day, 6 days a week trying to make that money. The fact is that you got to do a lot of research to get enough information to make this work correctly. And that's why, like Steven asked me, how did I learn so much? I've been researching this every day for the last year. I've been paying attention to stocks my whole life, or at least my whole adult life, ever since Bitcoin became a thing for the most part. So at least since 2009. But I never had the money to do anything about it. So even though I can crunch numbers and I can move money around and hypothetically in my brain on paper, this looks like it makes sense, but I never had a dollar to put up my first investment opportunity. This year I said, nope, I'm going to put something towards it one way or another and see what happens. And I've been successful ever since. The big brokerage business model is built on convenience. They sell the idea that you can pay them a fee to handle everything. And it's true. The dividend capture is the opposite of what their platform is. It's not passive. You have to screen the stocks the way I do, track the dates the way I do, analyze the charts the way I do, and execute the trade. So now you have a go-to podcast that will remind you every week, throughout the week and every month, of the effective cash dividend stocks that are paying out the most quantity of money with the lowest quantity of buy-in. So all of the research has already been done for you. You just show up to the podcast, hang out until I give you the stocks. And I'm going to give you the stocks before I go off the air. And you're going to take those stocks and you're going to buy into them. Since I'm talking to you after the market has closed and the market doesn't open until 9:30 in the morning Eastern Standard Time, you have in Florida right now, it is 1 a.m. You have 8 more hours to make your trades so that when the stock market opens, all of your trades are going to occur. Coming to the podcast, everything is settled. So whatever transaction you're going to make, the stock price is the stock price right now today. It's a business and you have to treat it like one. I keep telling y'all, live your life like a business. So when I say Wall Street doesn't talk about this, it's because it represents everything they sell against, which is going to take profits out of their money. It's active, self-directed, and puts all the power and responsibility in your hands, the individual, not the Wall Street investor. They know the average person doesn't have the discipline to navigate the traps, but the fact you're still watching proves you're not the average person. So you're willing to learn the details, and that's why you have a chance to make this work. Theory is great, but let's get specific with a real world trading plan for the next month. You've asked, how does this work? So we're going to map it out for you because this is what we're doing this month. First, a massive disclaimer. This is an illustration, and I am not a financial advisor. I'm telling you what I am doing. And then if you follow my lead, then you will be able to make success off of this as well. These results are hypothetically, legitimately, actually occurring in real time, but under the assumption of legal practices is that I am not giving you financial advice. I'm telling you, hey, do what I do, but based on a specific plan under specific assumptions. If you do your research after you get this information from me, you're gonna see success. Me and Steven seen success. Bayside seen success. Of Rev Chap 76, Usman has seen success. So this is common knowledge that is not all too common, because we don't talk about saving and investing money throughout our day. We talk about chaos. We talk about girls acting inappropriately. We talk about everything that is not worth our time. People embarrassing themselves, people fighting in the street, crime, stuff going on in other countries that we can't afford to get to, but we don't talk about how to make, save, and invest money. And the funny thing is that the wealthiest people in the world only talk about money. Every conversation they have is backed by money. They're going to a meet and greet because they're going to meet people who might invest in them later. They're going to a soiree because they're going to expose themselves to the network of people who have money. So when they want an investor, that person remembers who they are. They're networking. So leaving their house is a job because they're showing up, shaking hands, making people laugh, enjoying the day with people who later on will give them money because they know who you are. And then you take their money and you go make a profit with it. If you have a business deal, you offer it to them, they'll invest in it. Y'all both make a profit. If they have a business deal, they'll offer it to you because you're in a room. You'll take them up on that offer. Y'all both make a profit. So you showed up for the sake of showing up, knowing that whoever you talk to is going to put money in your pocket, indirectly or directly. Broke folks don't do that. We don't communicate with each other outside of the house. We don't talk about money. We don't talk about business opportunities. We're more quickly getting scammed by somebody on a social media platform to come and invest in some bullshit ass scenario before we talk to our homeboys, our friends and family members, our loved ones about financial opportunities that we can actually turn a profit in. And that's crazy. And my goal is to show you the process with brutal honesty so that you understand exactly how this thing works. But then you're also going to understand that if you follow some of the other shows that we talk about, you will see you can offset the loss of the taxation I'm about to talk about and have higher returns. So let's say we start with a $10,000 trading account. We started with way less. We started with $1,000 and building it up. Our goal is to roll this capital from one trade to the next, compounding our gains. The first one that we are going to do this month, All right. Pay attention. If you didn't have your pen and paper out, I want you to get your pen and paper out right now because I'm giving you some stocks. Okay. And make sure that y'all like and subscribe on the YouTube channel. Follow us on the YouTube channel so that y'all know what's going on. The first trade that we're going to do tomorrow, if you haven't done it yet, is to Harbor. Okay. Going into the comment section. So y'all know that if y'all watching this on Twitter and you want this information again after the show, go to YouTube and replay the show. At this moment, when I start talking to you about this strategy, the comment section will pop up with these trades in the comment section in real time. So if you don't have the ability to write this stuff down right now, you can replay the show and write the stuff down later. It is always accessible to you. And I'm not taking these shows down. So these strategies will still be up there a year from now, 2 years from now. So if you want to go back and learn about some of the other things that I've been talking about that I told you that I covered on the show, if you go into the search bar of my channel and you type in some keywords related to those topics, you will see shows related to those topics. Trusts, LLCs, C corporations, tax liens, all that stuff, tax exemptions, all that stuff. Type that stuff into the channel. I got a show about it. I talk about a lot of things. I talk about a different topic every day of the week. Now, the setup is going to be Two Harbors. TWO is trading right now today at $10.90 with a generous 45-cent dividend per share. That's a 4.1% yield for the capture. The action date is July 2nd, which is today. If you buy 917 shares for a total investment of $9,995.30, the capture is that you already have possession of it for the ex-dividend date of July 3rd. The stock should open at around $10.45 a share, more or less. And let's say that the market is stable and it opens at about 10.55. We sell immediately. I wouldn't sell immediately. I would probably let it linger till the next day and see what happens, because again, it does bounce back. And if it bounces back and recovers, it might be 10.92 by the time you sell. And even if it is 1 cent more than what you bought into it, you didn't take a financial loss and you got 100% of the dividend capture gain. But if you sold immediately, you would take that difference. Gross position, we get $9,676.35 from the sale, which is $10.55 times 917. And we've captured $412.65 in dividends before taxes, for a total of $10,089, which means that we basically made $89. Well, technically, if we go back to look at how many shares we bought, less than $5, so you throw that $5 back on there, and technically we made like $89 difference in this particular example. But if you pay attention to the fact that if you would have bought this and got $412.65 worth of shares, and what I have been experiencing over the last 15 transactions that we've done is that I'm actually selling for more than what I bought in. So I'm getting the $412.65 and I'm getting the increase from the stock going up. In that scenario, you literally walked away with $412.65 from the one trade. That's what I'm experiencing, and that's why I'm telling y'all, get in here while you still can. The reality check is our gross profit is about $63.70 under those dynamics. And then if you incorporate the assumption of a 24% tax on the dividend, which is $99.04, and a $10 transaction cost, depending on what platform you're using, the capital loss on the stock which is $318.95, can offset the other gains, but the net result of this specific trade is a loss of $15.34, and the account value is $9,984.66. And this is the brutal truth. So because that is a possibility, a high yield often comes with a sharp price drop, and we accept the small managed loss and move on. But in our current market right now, if you would have bought in with $10,000, you would have walked away with $412.65 as your dividend. And then because the stock would have been between 5 and 25 cents more than what you bought in, when you went to sell, you would have gotten the difference of a stock increase instead of a stock decrease. Because if it goes up 1 cent per share, 1% per share, then it will be going up like off of a $10 stock, it would be going up like 10 cents. So if it went up 10 cents because it went up 1%, then it likely would go from $10.90 to $11 or $11.01. If you bought in at $10.85, it leveled off at $10.90, and then you sold at $11.01. The difference increase plus the full $412. That's what we're experiencing right now. And that's why I'm telling you, get in while you still can. Now, the next trade I want to tell you guys about is the one that we're going to do right after that. Now, notice the ex-dividend date this week, you buy in today, and then the ex-dividend date is the 3rd, and then anytime after the 4th, you sell it. Remember, the stock market is going to have 1 to 2 day hold time on settling money after a sell. So if you sell it on the 3rd, it might not be accessible until the 5th. If you sell it on the 4th, it might not be accessible till the 6th. Keep that in mind when you're working on buying and selling stocks that are closer together, which we're going to be dealing with in August. The second trade that we're going to be doing in July. The second trade that we're going to be doing in July, global net lease. Okay. I'm going to put this in the comment section for you. Make sure that you guys like and subscribe as y'all get this information. Global net lease has an ex-dividend date of July 11th, which means that you got to buy in by the 10th. The setup here is a global net lease is currently at $7.64 with a payout of 19 cents dividends per share, which is about 2.5% yield. Your action date, you want to buy in by July 10th. If you're monitoring the market the way I do, and you find that you can buy in before the 10th, like I told you that if you sold on the 6th, or if you sold on the 4th, the money might be available on Friday the 6th. You might buy on the 6th and find that the value is lower than what it would be on July 10th. So you don't have to buy on the 10th. You can buy anytime before the 10th, anytime after you've sold 2 harbors and capture the value. We used our remaining capital to buy the 1,306 shares for $9,977.84, because 100% of the money that we put into 2 harbors and the ex-dividend can be added to the global net. Now, keep in mind, if we would have started with $10,000 and we would have experienced a $415 gain, and say we gained another $20 as the difference of the increase in shares, we still would have been at almost $10,500 if we would have experienced 0 loss. But I'm giving you a hypothetical on how this could have gone, which is one of the reasons why some people believe that the ex-dividend rotation is not worth it to them. But under the current dynamic, it is worth it. Now, if we would have gotten that $1,500, $500 increase on our $10,500, we would be adding an extra $500 to this example. But under the assumption that you take about $9,977.84 and put it into the global net, it should open at $7.45. And let's say it's a good day and it only dips to 752, we sell the gross position that we have. We get $9,821.12 from the sale and capture $248.14 in dividends. The total is $10,069.26. Now, if we would not have experienced any losses, we would have had $248.14 from this one and $412.65 from the other one, which together would have been $680 in 2 trades that you would have gotten in gains. That's why I'm telling you, like, this is crazy. 2 trades over 2 weeks, you would have got $660 or so dollars. The reality check of the hypothetical scenario is that the gross profit is around about $91.42. And after 24% taxes, where they do not tax you during the year, they only tax you during tax season. So taxation only happens if you have no tax deductions. But if in the event that you have no tax deductions, after the 24% taxation hits, the dividend about $59.55. And on platforms that have a $10 cost, your net profit is like $21.87. The reality of it, though, I use Stash. I got Steven on Stash, and by using Stash, we only paid a $3 a month service fee for using the platform and have unlimited trades. So we're not paying the $10 per trade trading cost. So we can trade as much as we want. You just got to pay the premium for the platform. Now, the account value on that would be about $10,006.53, and we're back in the green. So it's a grind, right? The next one that we're going to be doing this month is Trade 3, Armor Residential Real Estate Investment Trust. Right? So we bought on the 11th. Well, we bought on the 10th. We held it on the 11th. We had to have sold it by the 12th. There's a 2-day hold at the most, which means that it's going to be accessible. Cash should be accessible by the 14th. Assuming that this is true and taking into account that the 14th cannot be a Saturday or a Sunday, you buy into Armor Residential. Now, the action date is July 14th. We roll our capital into Armor Residential at $16.75, which is what it is right now today, buy 597 shares for a total of $9,999.75. The dividend is going to be about 24 cents per share, and the capture date is July 15th. So we're buying it by July 14th. So when we sell, if we buy on the 10th, have it on the 11th, sell on the 12th, 2-day clear, it is cleared on the 14th to buy the stock on the 14th, and then, which you got to buy it before 4 p.m. Eastern Standard Time. So you might want to sell on the 11th at like 6 o'clock in the afternoon, and then buy on the 13th at like 6 o'clock in the afternoon, where it's bought by the 14th at 4 p.m. Either way, you're on the books before the end of business day on July 14th. The capture is on July 15th, and we'll assume a similar successful capture where the stock recovers slightly better than the dividend drop. So let's estimate a net profit of $50. So the account value is about $10,021.53. Trade 4, the next one that we're going to be doing, which is going to be at the end of July. So you have plenty of time from Armor Residential to the next 2 that we're going to talk about. And that is going to lead you to being able to juggle what you're going to buy, when you're going to buy it. But the next one up for grabs is going to be AGNC and Orchid Island Capital. Now, this is going to require a split because these are two different stocks. They are both monthly paying stocks, and both of these stocks have a 12 cents per share hold. But let's get into it because they both have the ex-dividend date on July 30th. So if you're going to put all your money on one, you have to pick which one you're going to do. They are different prices because let's get into it. Since we have two opportunities on the same day, AGNC at $9.34 with a 12% dividend payout, and Orchid Island at $7.04 with a 12% dividend payout. The action is that we would split our capital and we buy 536 shares of AGNC at $4,999.84 and 713 shares of Orchid Island at $5,019.52. You could say if you bought Orchid Island on the 23rd and caught it on a dip where it dropped from 704 to 699, you'd be doing all right. You could put all of your money on there and come out with a substantial increase. Or you split the difference because you're selling on the same scenario as you buy if you split the difference. Now, the capture is that whichever one you buy, whether you buy one, buy the other, or buy them both, you buy that on July 30th. If you execute both trades, these are monthly payers and often behave predictably, but Orchid Island is a little bit more volatile than AGNC. We'll target a combined net profit of about $35 after costs and taxes, which accounts for a value of about $10,056.53. Now, I understand that you would more than likely draw back because, again, I'm giving you options after 24% taxation has come out of your trades. You're likely to have acquired off of $10,000. You're likely to have acquired about $350,000 or $360,000 per stock from AGNC and Orchid Island. And you would have likely came back off of $150 to $200 on the stock for Arbor Residential. You overall, off of the five stocks that I talked about today, would have likely gotten really close to about 800 between, I would say more than 800, closer to 1,500 off of the four stocks if you're trading with $10,000, because Orchid Island and AGNC are stocks that are paying upward of 19 to 22% interest. And if you're getting 19 to 22% interest on $10,000, you're getting somewhere close to $1,900 or $2,200 of profit off the 10 grand, because that's what 22% is. So it's a lot more money that you're supposed to be getting versus what I'm giving you in the example. But when you're experiencing losses, this is how the losses feel, which is one of the reasons why not a lot of people try to do this. Now, trade 5, this is the must buy trade. This is the one that I just found this weekend when I was talking to you guys about curating the list that I had picked up at the beginning of June. And this must buy trade is Zim Shipping. So I want you guys to write this down, Zim Shipping. And this one is going to be a doozy. Now, the ex-dividend date for Zim Shipping is August 2nd. Now, this is going to be where the dividend rotation strategy becomes complicated. If you have a limited quantity of capital and you put all your capital into Orchid Island and AGNC, if you buy, the ex-dividend date is on the 30th, right? Well, yeah, the ex-dividend date is on the 30th. You're buying it before the 30th, July 29th, or the last business day before the 30th, if July 30th is on the weekend. If you're selling on the 1st or the 31st, if there's 31 days in a month, it's going to take 2 days to clear, which means the money's not going to clear until the 2nd. If you're selling on the 1st and it's going to clear 2 days later, it might not clear until the 3rd. This is where people have their hiccup with their trades. recognizing that you have a limited quantity of capital. If you're not willing to split your money 3 ways and you want to put the bulk of your dividend rotation capital into one specific trade, you have to put it on the trade that is going to give you the most return for the quantity of investment capital required. This must buy is pretty steep because ZIM is a high yield, high volatility stock where the dividend is a huge 74 cents per share on a $16.20 share price. So this is a high risk, high reward play. If you skip Orchid Island and AGNC and buy into ZIM before the 1st, which means that you're buying ZIM before the 30th instead of buying Orchid Island or AGNC, our entire capital would be rolling in buying 620 shares for $10,044. The capture date would be August 2nd. And due to the high yield, the price drop could be severe or not. This is where you must use a stop loss. But for our example, let's assume it works. The inefficiency gives us a larger than average net gain. The reality check, let's say we net $120 after taxes and costs. The final outcome would be for the entire strategy from the beginning of July to the beginning of August, we would have $10,176.53, which is $176 more than what we started with after taxes. Before taxes, though, significantly larger. In 1 month of disciplined active trading, we've turned $10,000 into $10,176.53. And that is a 1.76% return after taxes. It's not 168%, but if you could consistently repeat that result every month, you would achieve a 23% annualized return. Something else, which is higher than the 14.9% annual return off of leaving your money hanging out in a specific location. That's how you build towards a number like 168%. Through relentless repetition and compounding and utilizing tax exemptions to not have to pay out that 24%, while ruthless managing risk. If you're ruthlessly managing the risk on every single trade, you've seen the theory and the honest case study. Now, let's build the actual blueprint. This is your rule book. Find the right candidates like the ones that I have given you. The art of screening is the most important part of this process because you don't have to use the ones that I'm using, but these are the ones with the lowest buy-in rate and the highest profit per share. Doesn't get any better than this as far as value versus return. Since this is the most important part, don't just case the highest dividend yields that they claim that is definitely a rookie move. High yields often signal a company is in distress. I'm not looking at the percentage yields. I am looking at the dividend returns versus the buy-in costs. And every company is in distress right now because of the damn stock market, because of the tariffs, because of the trade wars, because of the bombing in the Middle East, because Canada is no longer accepting American products. Everybody's in distress right now. Here's what you're looking for. Stable, liquid stocks. Focus on large and mid-cap companies. They have high trade volumes, which means tighter bid-ask spreads and easier entry and exit levels. So this is if you were utilizing TD Ameritrade or Acorn, where you were buying actual shares, or if you were doing option buying, where you were buying 100 shares of a stock off of buying a single option. The contracts. I am also talking to you about using ETFs trading, where you're buying the value of shares through ETFs instead of actually buying the stock itself. which gives you a lot more flexibility and less cost to buy and sell the stocks. Looking for the low volatility, because if you're looking for stocks with a beta below 1.2, ideally below 1, you want boring and predictable, not wild and swinging. You want something that's not doing nothing versus something that's always doing something crazy. Pay attention to the history of the price. This is the secret sauce. Research the stock's last 4 to 5x dividend dates, which means that if it's a monthly, you're looking back at the last 5 months. If it's a quarterly, you're looking back at the last 5 quarters. If it's annual, you're looking back at the last 5 years. How did it behave? Look for stocks that consistently recover their price within 1 to 5 days, which means that if you buy it during the dip 5 days before the ex-dividend date, and then you sell it after the ex-dividend date, it'll bounce back and recover. You'll see your profits, and everything will be copacetic. Some data providers can help with this, which makes it easier for you. But you want to avoid earnings announcements. Never attempt a dividend capture when an earnings report is due. Price swings from earnings will dwarf the dividend effect. The critical timing of entry and exit is also equally important. Your execution must be precise. Just like I explained to you last week how I skipped over the 23rd and did not benefit from the extra 4% increase, which expert investors would consider that a financial loss. Because I could have done it, I just didn't. Now that I've learned from the change, now I can capitalize it on future trades. Buy the stock on the last trading day before the ex-dividend date to minimize the market exposure, or you can monitor the stock the way I do, and then you buy the stock when the stock dips a few days before the stock ex-dividend date occurs, so that you can participate in that volatility and receive the gain, which is what we've been doing over the past 2 months. Your exit is the biggest piece of this puzzle. You want to decide your exit plan before you enter the trade. The scalper's exit allows for selling immediately at the market open on the ex-dividend date. This is simple and systematic, which means that if you bought in the morning before the ex-dividend date, and the ex-dividend date occurred, and then say you ate dinner with the family and then sold the stock before you went to bed, when the market opens in the morning, it would sell the stock. Your target price exit is the next thing we are addressing. Set a specific target sell price. If you bought at $50 and dividends is 50 cents, you might set a limit order to sell at $49.75 or higher. The recovery rate sucks, but wait for the price to recover to your entry point before selling. This is risky because you could end up holding the stock for weeks, defeating the purpose of the strategy. But like we discussed at the beginning of the show, if you buy and hold until you can sell, then you will not lose any money towards the stock. You will lose money towards your traction on the dividend rotation strategy. But I would prefer to hold money on a dividend rotation strategy until such time as I can afford to make a profit, instead of losing a large enough quantity of money off of the sell to end up costing me all of the profits that I've gained so far. Some people might stick to the first two methods when they're starting out, but those individuals that get more experience will make more dynamic trades in more effective ways. The silent killers are truthfully mastering taxes and the cost of trading platforms. As discussed, these dividends are taxed at your ordinary income rate, and the best way to mitigate this is to trade with a Roth IRA where your gains grow tax-free. Roths have contribution limits, but for a smaller account, it's the perfect vehicle. So if you use a broker with low or zero commissions, low or zero commissions, and tight spreads, every penny you save from fees is a penny added to your profit. Next is the risk management, where your only safety net is this non-negotiable rule of 2%. Never risk more than 2% of your total trading capital on a single trade, which isn't the practice going all in for each one of the ones that's giving you a large amount. But if you're going all in, then hopefully your money's still free, or you're not taking a loss if you're not getting money out of the situation. For an account that's a maximum potential loss of $200, and you use the stop loss orders, where this is your emergency brake. Before you trade, you must know your exit point if the trade goes south. And a logical stop loss might be just below the price you'd be at after a full dividend drop. And this prevents a small loss from becoming a catastrophic one. And know when to walk on a stock. You will have the losing trades, and it's statistically certain. You want to not get emotional. Do not revenge trade, and accept small losses as you move on. The goal is not to win every time, but to make sure your wins are bigger than your losses on average. How the blueprint turns a gamble into a calculated business operation. And we're going deep here. If you're getting real value from this, honesty and the most clarified breakdown, the kind of stuff you don't normally see, do me a small favor and hit that subscribe button, and share the show with somebody who can benefit from it along with you. My promise is to deliver actionable, non-hype centered content just like this. So I appreciate your support more than you know. Now let's get to the most important question. I've laid out the entire framework, and now we need to be frank. This strategy, despite its potential, is absolutely not for everyone. First, who is it not for? This is not for the passive investor. If you want to set money aside and let it grow slowly and steadily, this strategy is worst nightmare for you. For most people, consistently investing in low-cost, diversified index funds is the best path to long-term wealth. It's proven effective and requires almost none of this active work that we're talking about today. This is not for someone who is emotionally reactive. If a 1% drop in the stock is ties to your stomach, where you end up feeling like there's knots in your stomach, you will be destroyed by this strategy. It requires calm, detached, and disciplined demeanor. This is not for someone who is trading with money that they can't afford to lose. And this should be obvious, but it has to be said, because this is not a way to turn rent money into a down payment. I can't believe I had to say that. This is a high risk strategy that requires dedicated risk capital that if you lose it, you're not missing out on your lifestyle. So who is this strategy for? It's for me. This is for the active, engaged investors. This is for the people on the channel that's watching the show right now. This is for the person who enjoys the process of analysis, execution, and management. So you have to see it as a challenge, not as a chore. And this is for the disciplined individual, where the person who can create a set of rules and follow them without deviation is the one that is liable to be the most successful. Now, this is for the lifelong learners, the person willing to do the research, back test strategies, and consistently refines their approach. Ultimately, dividends captured tools are in the hands of a skilled craftsman who respects its danger, and it can be used to build incredible things. In the hands of a careless amateur, it can cause a lot of damage. So before you even risk money, paper trades, this strategy for at least a few months, use a simulator, follow your blueprint, prove to yourself that you can do this with discipline before you risk a single dollar. And if you're following us along the trends with the trading, then you too should be receiving the gains that we're discussing. Now, we've covered a lot today. We started by talking about the limits of purely passive investing. We've unveiled the dividend capture strategy as a way to actively generate cash flow. We went deeper. We looked at a real world monthly trading plan with brutal honesty. And we're showing how successful trades result in small incremental gains in some situations, including trading costs and taxes. But also note that each one of them was really close to $500 in profit. And if you exclude taxation, where you're running over about 15% profit off of the initial principal, you're likely to walk away with $1,500 to $2,000 a month worth of profit off of just moving money around in your bank account. And then we went through the step-by-step setup for the blueprint, scanning your focus and screening of things, time, and non-negotiable risk management. So what's the secret? It isn't some hidden formula. The dividend capture strategy is well known. The real secret is that success is the market that comes from discipline. It also comes from education and treating it like a business. Now, it comes from understanding the risks so you can navigate around them while others fall into the traps. Wall Street doesn't hate the strategy. They hate the empowered, educated investor who has the discipline to use it effectively. An investor who no longer needs to pay them fees for mediocre returns. All right. Now, my goal wasn't to give you a fish. It was to teach you how to fish, but also warned you about the sharks and the storms. The path to these kinds of returns is not easy. It's paved with discipline and consistency. And the real price isn't a headline number. It's the process of taking control of your financial destiny. So if today's show opened your eyes, I want to hear from you. Drop some information in the comments section and let me know your single biggest takeaway from today's show. And the rest of you can join in as well. Are you going to try paper trading the way we're doing it? Or what questions do you still have that are holding you back from the trades? I read pretty much every comment that comes through the channel over the last few months, because I actually, one of the reasons why I was late today was because I was responding to one of the fans while I was getting the show together. And if you haven't already, please hit that like button and help this video reach more people and subscribers for more no nonsense financial content. And we want to take control of the disciplined and all see the in-video behavior in order for us to make the best profits out of our trades. Now, today being Wednesday, we're going to be talking about different countries to invest in, covering countries that we haven't covered already. And apparently we're not going to Iran or Iraq because it's hostile environments. So we have a little under 198 countries that we can, 198 countries that we can go to. But when we get there, places where we could put our money, things that we can do for the low, and other such things like that. That's what we're going to be talking about tomorrow. That's all I have for you guys for today. So I want you guys to come back tomorrow. And if I come across any financial information that you must need to know, I will throw it into the comment section the way I threw in these 5 trades. That's part of the different dividend rotation strategy. Now, as long as the situation doesn't make sense, I'm going to keep asking you ladies to make it make sense. So ladies, please make it make sense. And then fellas, this is the opportunity for you to take action to make yourself a higher value individual, but it requires effort and research. If in the event the ladies can come and learn this too, they can get out there and invest just as good as a man, and they're not easily distracted by the opposite sex. So it's not like they're going to make a bad business deal with trading stocks so that they could take you out on a date. Get your finances together, get out there and get it done. Remember, since we are live 7 nights a week and we don't let the sun rise without going live, this is a 75% male-driven podcast from the male's perspective. So you will get some advice that is directed towards the men, but ladies, y'all can take this advice and utilize it to make yourself a higher value woman as well. We don't just work on your finances. We also work on your decision-making so that we can work on your capabilities to not negatively impact your financial success by making bad decisions in your personal life. So this is a holistic show that is not going to sit here and whine and complain about how life sucks. We're going to talk about how life sucks, why it sucks, and what we can do to improve it. I've been telling people more often than not lately that you need to get can't out of your vocabulary, because you can do whatever it is that you want to do in your life, short the things that somebody else who has more control over your situation stops you from doing. If you're looking at a situation, there isn't anybody else in this situation deliberately stopping you from succeeding. In that situation, you're not failing because of situations beyond your control. You are failing because you are refusing to perform that action. So if you recognize that I've given you at least 5 trades right now, more than 5 trades right now, that genuinely would be wrapped up in a platform. If we don't pay attention to what we're doing, we would lose what we're losing because of what we did. Nobody else is stopping me from making a trade. So I'm not going to say I can't trade in what I want to trade into. I can. I just have to split my money. I'm not going to say that I can't make a profit off of this. I can. I just have to invest correctly. I make informed decisions and I watch my calendar so that I'm not making mistakes, so that I don't miss out on the trades. We have to continue to take different approaches in our lives. So I want to thank you guys for coming to tonight's show. Thank you for coming to this and that all together. I'm your host, Xander, where we talk about this, that, and everything in between. And I will see you guys tomorrow night.
That's my personal command. I'm not mounted on higher ground where excellence is found. My potential knows no bounds, raising the bar, breaking ground. I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never yield.